Okay, great. Let's carry on to the next area. Interest income. So a couple of things here. Just really now, this is sort of saying we're finished dealing with trading income. We're done with trading income. Trading income done. What's going on with interest income? And this is very, again, it's not absurd, right? That when I say interest income, interest. So I think it's easier to, so it makes a bit more sense for a trading company for us to talk about expenses. Then it must be obvious, right? That if you borrow money for trade related purposes, so typically here to buy some plant machinery, you would have an interest expense, finance costs. Pretty straight. And if you like, whatever, a loan for an overdraft to fund daily operations, and any interest involved in the writing off of trade receivables will go to this sort of this bracket, if you like, of interest. Yes. Now, again, the only interest we expect you to ever receive really as a business is typically to do with, say, banking interest, right? So, this is what we typically expect that you will receive. So we don't really expect you to receive interest unless you can see here it says if trade is lending money, example a bank, but you're very unlikely to see this. So it's most of you will see is an interest expense. Right, and then of course, in terms of trading. But of course, if you buy some property, for example, and I just want to highlight that here very clearly. For property, all the interest relating to property is not property expense. Yes, all the interest relating to property is in. So, for example, the interest on the loan to buy a let property or whatever, any of your property, all comes into under interest. Cool. So if you're buying shares in another company, interest paid on overdue corporate tax, if you're writing off a non-trade loan, all that interest here is to do with non-trading, right? So all of this here will happily take place, if you like, within our trading. But once we start talking about non-trading, we're talking about everything else happening, if you like, here. So we expect to see this, if you like, in our trading, but all this here. So here we are. So non-trading, any other interest received by government bonds, if you have some government bonds, but nothing to do with your trade. It almost just lines up quite nicely. Interest on repayments of corporation tax. So we have that. We have that over there. You can see this telling us very clearly include amounts as part of trading profits. No need to adjust. And interest income in the accounts should be deducted from trading income. So very clear as to what's going on, over here, right? So include as part of interest income as we go along. Let's see. I think what's next. Yes, again, it's always about the driver. What's driving it? So if you see a scenario where you have a loan, the interest relating, we have quite loan relating to, is it a trading issue or is it a non-trading issue? If it's a non-trading issue, then put it in non-trading in the interest bracket. If it's a trading, sort of leave it within trade. Again, the write-down of impaired debt, which relates to the lending of money, is also dealt with within loan relationship rules. And most of the time, this is an impaired debt, lending of money. So typically, this is not trading. Right? So this example, this in class as well, but I'll just highlight what's going on here. They do help you here. Bank interest payable on loan to buy machinery. This is trading. This is fine. This is very clearly. So, but all of this had been worked through your net profits. So if this is fine, leave it there. Of course it is. It's okay. It's to do with trade. But we have issues here. This is a non-trade. This is bank interest receivable. So bank interest receivable. It's not to do with trade. You're not trading. You just have a bank account and you receive this, or whatever reason you receive bank interest. So all this has to come out of your trading and go into that interest income sort of bracket, and you deal with it there. So you have so work through this, but the key point is these three things have to come out and be in their own separate bracket. They will still get taxed, but they just won't be in the same bracket as trading income. Yes? So yes, please. I think that's example 3. I think it's good doing this as the examples go along, and that's the end of this video. So have a look at that. just to make sure you're happy.